and welcome to the first edition of Acuity Talks, an ESG podcast where we will discuss everything that is trending in the ESG domain. I am Ananta and I am part of the investment banking domain at Acuity, supporting clients on ESG engagements and sustainable finance services. The topic for today is ESG Rankings and Ratings, an important measure of ESG. The growing consumer awareness about ESG, the social and environmental factors, and the awareness of investors on how to put forth money into more sustainable projects, there is a need for companies to ensure that they have sustainability business practices in place. There is also a higher expectation and requirement to be able to compare ESG performance between various companies. To discuss more about the relevance of ESG rating, their implications, and impact on financial decisions of investment banks, we have with us Prachurjya Bharaly, Associate Director, Investment Banking. Prachurjya comes with over 16 years of experience in the investment banking domain and has played a pivotal role in setting up teams to support various investment banks in ESG advisory, ESG DCM, as well as sustainable finance. Welcome to the podcast, Prachurjya.
Thank you, Ananta. And it's a pleasure to be here on this podcast today with you.
Let's dive right into the topic. The first question that I have for you is, what are the benefits that companies gain if they start focusing on ESG ratings?
To start with, ESG rating, or we call it ESG score, it helps a company get an independent view of the sustainable performance, and at the same time, it helps the company gauge its position in the industry compared to its peers. There can be multiple benefits of having a positive ESG rating. First is it can help the company gain access to capital at a lower cost, because when we have a higher rating in terms of ESG, then it's going to attract a broader pool of investors or lenders. Secondly, it's going to help the company in terms of enhancing its brand value in the market as well as the reputation that it has, because a positive ESG rating is going to contribute towards the reputation of the company because the company is doing its business in a responsible manner. Third, it can help the company mitigate the risk that may arise. When we talk about ESG rating, we are actually trying to assess the company on various environmental, social, and governance risks that may arise in the future. So, proactively managing those risks can help the company better manage its resources.
That was a very interesting way to look at the importance of ESG ratings. I do understand from what you said that operational efficiency increases when ESG ratings are taken into consideration. However, I do understand that a lot of traditional businesses will have a little bit of hesitance in undertaking sustainability disclosures or focusing on higher ESG ratings. When we talk about moving towards that direction or taking a transition towards ESG ratings, what do you think should the company start with? Where should they begin in that journey?
So that's a good question that you have asked. If I talk about the potential investors in this space, so if I talk about Goldman Sachs Asset Management, Vanguard, or if we talk about BlackRock, so they are looking for financing companies that have a strong ESG track record and are always following an active and responsible business approach. Having an ESG rating can help the company have a better understanding of its business, how it's performing with respect to sustainability compared to its peers, and what could be the potential business or areas of improvement. These potential areas of improvement with the materiality assessment, the company can find out how it's going to engage more with the stakeholders, whether it be internal or external, trying to see what are the expectations from the stakeholders, so both from inside as well as outside. So then they can align their ESG strategy roadmap, which will be a comprehensive one, in compliance with the regulatory requirements or the regulatory top global regulatory requirements, which are, if I have to be very specific, naming just some of them. So we talk about SASB, ZRI, and TCFD, to name a few.
Now, that was a very informative way of how a company can start its journey towards focusing on ESG ratings. Just mentioned about how there are various regulatory frameworks that a company can align with. How do you think a company can navigate this landscape around ESG ratings when there are so many different agencies who are actually conducting ESG ratings based on their own methodology? How do you think a company should navigate this landscape?
In the current time, there is not even a single methodology which is universally accepted when it comes to arriving at ESG rating. Many of the big known ESG rating advisors, so naming a few, Bloomberg ESG Data, MSCI, Sustainalytics, then we have Moody's ESG, then FTSE Russell's ESG rating. So all these agencies have their own reporting methodology. So what these companies normally do, in fact, the rating agencies, they are actually looking at the sustainable performance of the company, evaluating the company on various ESG parameters, whether environmental, social, and then ranking the company's performance on a scale of 0 to 100.
Now, I have two-pronged question after this. One, how are ESG ratings supremely beneficial to investors? And second, which is personal to what we do at Acuity, how are we supporting clients on their journey towards ESG ratings?
ESG investing is helping institutional investors while picking companies because they are looking for financially successful companies that have made a positive impact on the society and the environment. So, some of the main areas that an institutional investor is looking for while they are deciding on a target is, first of all, it helps the company to mitigate the risk because there will be potential ESG risk which will come in the future. So, that helps the company mitigate the risk or manage the risk within its portfolio. Secondly, the company, if they are picking a company which has a high ESG rating, then it means that the institutional investor is placing their bet on a safe company. Third, which is the company which has a better ESG rating. So that company is also already doing its business responsibly, and they are following all the business practices that needs to be followed as per the regulatory requirement. So they are already compliant with the regulatory requirement. So there is no risk for the institutional investor when they invest in such companies. Keeping these things in mind, institutional investors, they normally do their own due diligence and they have a holistic approach of integrating ESG parameters along with the traditional financial metrics which they are always going to use, like revenue, EBITDA, then the different credit ratios that they are going to think about. Now coming to our next question, how we support the investment banks or the advisory firms. We have definite set of clients when it comes to investment banks, and within the investment banking community we have clients who have sustainable finance team. Within sustainable finance we are looking at ESG rating. Then on the other hand, if I talk about advisory firms, so we are supporting independent ESG advisory firms as well. Okay, so the primary objective or the primary task that we do within Acuity is looking at companies, trying to do a thorough assessment of their sustainability performance on the various ESG parameters. Why we are looking at ESG rating? Because we are helping the investment banks help their clients in raising different types of financing instruments which are currently very hot in the market. So we started with green bonds. We had that social bonds which was there during COVID time, and in fact most of the big sovereigns, they went for social bonds. Then we now have a new type of instrument which has come into the picture. So we talk about SLBs, which is sustainability linked bonds and sustainability linked loans. So if we talk about companies which are in the heavy emission intensive industries, so we talk about coal mining, then we have oil and gas. So these companies where banks have already stopped lending to them, and they have specially told them that we are not going to lend money to this sector because in the future, so when we talk about so many carbon intensive industries which are there, so banks have to help their clients transition from a carbon intensive area to a net zero target, right? So there we help those investment banks with respect to different types of research and analytics requirements that they have. So that's where equity is going to help those ratings and prices.
Great, Prachu. It is very informative what all you have told us that Acuity is doing for its clients in the domain of ESG rating. This session has been very informative for me and very educational also, where I have learned that ESG ratings are here to stay. They are important for both organizations that are in the market as well as investors. And ESG ratings will help them both in growing their businesses towards sustainability. Thanks again for your time, Prachurjya.
Thanks, Ananta.
This is Ananta signing off from Acuity Talks.